Now, before we kick off segment 2, we'd like to remind you, please like, share, subscribe. Your support is appreciated. So when we look at what has happened and how we closed out 2021, you can see that we had that pretty sizable drop as we got into the end of the year. And then that really continued on. So when you look at the current, right now we had 13.5 million barrels of demand versus last week, which was 13.686. So you saw that continuous slowdown, bringing the average to about 14.4. And now we think that it's just, as we were saying, we think it's going to stay in this depressed level, somewhere below 14 million, just as we have some of that overhang. And it's multifaceted in terms of what is driving it. So I know for most of the people in New York, at least, and I know that it's happened in some other areas, work from home has picked back up, telling people just to stay home, avoid some of this exposure given where Omicron is, letting those numbers peter out. There's been some, essentially a view of just stay home in January, and then you'll start to see the return in the first week of Feb, as long as things kind of, I think, go the path that we think it's going to go as well. Well, you're probably starting, if we haven't peaked, then we're going to peak this week. And then you'll see a fairly sizable drop as we go into February. And then the view is that you'll get some of that pickup in Feb. Now, as you can see from the chart, that's kind of normal when you look at where that pickup in activity comes. It's usually in the end of February. So we think that we're going to be depressed until we get to that first week of Feb. And then you'll start having it move. It'll still be below normal, but it's going to have, again, a bit of a better rate of change. It'll still be below where we normally were in 17, 18, 19, but again, starting to close that gap a bit. So that'll be a little bit of that positive as we go into February, and then setting up for March. Now, the weather can change that. If we have a really snowy Feb, that always impacts kind of how much activity you can do, how much driving that is possible. So there's weather with this, that's, discounting weather. This is what should happen based on what we're seeing and what we're hearing on the ground. So now when we shift to Distillate had a build of 2.54 million. That's 20.7 below the 5-year average, with most of that, or I should say half of that, residing in Pad 1, which had a small drop of 130,000, which is 10.8 million below the 5-year average, while Pad 3, small build, sitting at about 8.5 million below the 5-year average. We think that Pad 3 is going to start to catch up. And Pad 1 is going to remain, you're going to see those draws just because there's not as much refining capacity in the region. That's where heating oil is consumed the most. So it's really, as these builds kind of continue in their own right, it's really going to be driven by Pad 3. And but when you look at the 29-year average and you look at that dotted line, you can see just how far below we are. And you can see that we normally have drops into, let's call it, the middle of April, and then you start to see that build back up, which then crests and peaks around, let's call it, the first to second week of September. We just think that based on where supply is, where demand sits, you're going to have a fairly flattish number where you're going to get some small builds, you're going to get some small draws, and that's going to put us in a better position versus historics, while we're not going to have much change up or down, just given where things are. Heating oil, obviously this can change if we get a polar vortex flying through and hitting it, as we had over the weekend, where I think it was, it was yesterday, that was, I woke up to a -2 degree Fahrenheit wind chill. So if you get more stuff like that, you're gonna see this remain in a very bullish position. So there's a lot of weather kind of married into that, but the diesel side, what's going into trucking, that's going to remain strong. We don't see that ebbing at all, especially given as the supply chain remains fairly tight. Now on the import side, it was down just 2,000 barrels a day, just 4,000 below the 5-year average. But when you look at Pad 1 was up 33,000 barrels a day. That's 4,000 above the 5-year average. That's something that we do think continues, just given what is in the market, how much is going to come from the Middle East and come into the Atlantic Basin, as well as other areas. And now we have some more grains maintenance data coming out, which we will talk about in segment 1 of the Econ Show. So now when we look at distillate products supplied, when you look at the demand, you can see that we're essentially starting out right in the midway point. We do think that this is going to shift up before it comes back down. And you can see that based on the 5-year average, it stays fairly tight. And it's really driven based on heating oil demand is going to be at its highest in January, February, and depending on what the weather does, the first week of March. Diesel is going to be there. So we do expect to be above the 5-year average when we take this year's average out, because it will be lumpy. You will see this remain robust into the end of Q1. And here's one of the reasons why. You got a nice spike into trucking demand on the demand index. You can see load availability spiked back up, but we also have rates going back up driven by diesel prices. Diesel is really moving back up. That's something that we think diesel prices, especially as we have crude WTI at 83, you have Brent at 85. That's going to bolster where gasoline and diesel prices are going to end up. Now on the rail traffic side, we had that sizable slowdown in the first week of Jan, which is a mixture of tough comps, and then you normally have kind of the sluggish start to the year. So versus 2021, obviously you had a sizable drop. And comps are going to be difficult. So it's going to be worth looking at how are things trending, which is why when we look at the CAS data that came out today, you can see what the weekly North American rail volumes by segment show. And this is looking at that year-over-year change. So we had, things were going fairly well into year end. Then you had the first year kind of sluggish start. That's due to year-over-year comps, but also just, you had everything pushing as hard as possible. Then you have some vacations, some downtime. And now you also have labor shortages due to Omicron, due to quarantine restrictions, which is also causing some of those excess delays, which is dropping this down. So we do expect to see it start to go back up, especially as we go through January and into February. Now, when we talk about some of those tough comps, and the reason why we're going to kind of climb that ladder is because there were also tough comps on the shipping side, but yet we're still up versus previous week. We're fairly in line with where we were versus the previous year. So the ships haven't stopped coming in. The 20 equivalent units, the TEUs, are still coming through. So again, this is all going to just show that we're going to have support in the trucking side. We're going to have support all the way through. And this also bleeds into we're going to have support for rail, which again is going to shift us higher. Now, when we look at heating oil, you can see that in the Northeast, where a lot of this is consumed, we're going to remain below the normal temperature. And then when you look a bit shorter term, you can see that essentially from the Great Lakes east, you're going to have some fairly cold temperatures remain, and then that's going to stay through essentially through January 21st. That will support some of that drawdown of distillate heating oil, especially in pad 1, but you're going to get some warmth coming through in some of the areas, essentially the Midwest, South, and into the West Coast. And some of those guys in the Midwest states as well as the North do also use heating oil, so that's going to offset some of that demand. But because the key is happening in the biggest consumption areas, we do think that that's going to result in some of that robust distillate demand, as we've been talking about on the heating oil side, and keep that storage fairly, really not dropping the way it, really not rising the way it should, because we will see some robust movements, especially on the refining side. Because when we look at refiners, when we look at gasoline yield dropped by 1.3%. That's now below the 5-year average, while when we look at distillate, it only dropped by about 56 basis points. And so we do think that distillate will remain the focus. Gasoline, they'll try to manage the best. So that demand will pull some from storage, even as refiners try to increase it, and that'll keep us in that fairly tight range through the storage component. So now when we look at gasoline had a build of 7.96 million. We're now only 3 million below the 5-year average. We will likely close that gap over the coming few weeks. And the reason why is when you look at the 29-year average, you can see that we typically get a fairly sizable build in gasoline. We think that the pace is going to slow a bit just because we have those refiners going into downtime, some of that, but we think it's going to be more than offset by that fall in demand, which is going to keep gasoline storage elevated. Builds will slow, but it'll still be strong, and that'll close that gap. Imports were down 6,000 barrels a day, still 120,000 above the 5-year average. And then even though PADD 1 was down 61,000 barrels a day, it was still 20,000 above the 5-year average. And that's where we think that's going to remain. As we said last week, we expected a drop in imports, but we do expect it to stay above where it normally is for this time of year. And as gasoline builds continue in Europe, that's going to, again, free up some of this to come back into the U.S., to head into the Atlantic Basin. And whether it ends up in the U.S. or in Latin America, this is where we're going to see some of that additional cargoes coming from Europe and competing and trying to find the best market as the things deteriorate a touch in the U.S. Now, on the blending component side, you can see we had a build of 5.82 million barrels. That now brings us 4 million above the 5-year average. And typically, blending components is a fairly good indicator of where are we going to end up coming forward. So again, this is giving us that confidence that we will see that get and gasoline builds now cross that 5-year average. Start to see and get much closer to where we were as we headed into 2019 and 2020. So then when we look at why we're saying this, well, now when we look at China, you can see that the congestion index has flatlined. We think it's going to, again, bounce between that 95 and 98, depending on restrictions. So there's been some new restrictions, even though there's been talk about getting rid of that quote unquote zero tolerance for COVID. We don't think it's going to happen, and that's going to keep things a bit sticky in terms of below normal. Google Mobility Index, had a big drop. A lot of that was driven based on people going home for the holidays, New Year's, but you can see that the recovery has been very slow. And a lot of that is due to Omicron, because people, instead of going back to the office, they said, look, stay home. And we have had some restrictions increased. And it's basic. It's things like, wear a mask, things like that. It's normal, and it's not, I should say it's the new normal, but it's not deterring many people from going out and doing and carrying out their daily lives. But as we've been saying, especially like taking off my New Yorker hat, when you go into other areas of the world, a lot of people drive to work. Typically around here, if you drive to work, you would essentially just turn the car and aim it for a tree because you just are going to hate your life. So most people take mass transit, but in a lot of other areas, you're going to drive to work. So you're going to see that sizable drop in the weekday data. And because of some of the restrictions at restaurants, capacity issues, we're not going to see the same an increase on the weekend. So if you remember when we were talking in the summer and into through 21, and we ended up being right, we saw a 5 to 10% decline in activity on the weekday and a 5% to 10% increase above normal on the weekend. Now we're shifting that for what's happening right here, where we're going to be about 20% below normal, 20 to 25% below normal on the weekday, and about 5 to 10% below normal on the weekend. And we'll show that in the last slide, looking at OpenTable. Apple Mobility data is also drifting lower. We think it's going to, just based on when it's snapshotted, just based on what that index is using and what that average looks like, it'll trend lower, but still remain above the baseline. Now, when we look at Gas Buddy data, you can see that we've had that continuous move lower. This is exactly what we were expecting in terms of this down move, and we expected to have a sizable down move, but then it just stays here, and it wasn't going to snap back up. It was going to move, let's call it 1% up or down from this baseline. And so far, we're actually trending at about 3% below baseline. So we do expect to see some additional deterioration into a weekend. So according to Gas Buddy data, weekly total U.S. gasoline demand fell 1.1% from the prior week and was 6.7% below the 4-week average. Every day but Saturday saw weekly demand lower than the previous week. According to Gas Buddy data, on Sunday, demand fell 7.2% and was down 13.3% below the 5-year the 4-week average. And it was the lowest Sunday in nearly 11 months. So then when we look at according to Tuesday, so Tuesday U.S. gasoline demand fell 3.8% from the prior Tuesday and was down 7.9% from the average of the last 4 Tuesdays. So the average sounds worse just because you had Christmas, you had New Year's, so that's a little skewed. I think it's better to look at that week on week because that's where we see some of that cool off, and we think it'll come down a bit more. And again, as we saw on the total weekly data, we were down 1.1%, and we expect to see some of that pressure being that down 1%, maybe up 0.5%, but staying in this depressed level through January and into really the first 2 weeks of February before we start to see some of this reverse. And this is something that isn't going to help another bounce in gasoline prices. We were up over a penny, bringing us just below $3.30, so at 3.295. We're going to cross $3.30 by the end of this week. I think that's kind of a foregone conclusion. It's just a matter of how much higher does it go? Does it get back to $3.35? I would say yes. The slowdown in demand will help cap how fast we get there, but I think we're going to see some of that movement in general on the gasoline side, moving about a penny to 2 pennies a week. Now, on the inflation front, that's going to be a problem when you're looking at flexible pricing, just because this surge back up is going to essentially be a driver for where we are in January. We were expecting inflation pressures to ease a bit and actually go negative in January and February. But this is going to be something that's going to offset that a bit, and maybe instead of it being negative, just being fairly flat. Now, adding to that pressure is the diesel side. So diesel was up just over 4 cents, bringing us to $3.657. So just over $3.65, and we think that'll cross to $3.70 very quickly on a mixture of heating oil demand, as it's essentially equivalent now to road diesel, and we do have the supply chain issues and some of that trying to make up. So now when we look at the CAS index, which came out, you can get an idea of where freight rates are and how how explosive they were. And again, that was driven by labor and diesel, and now we're getting some of that push back up. Now, when we shift to blending components, you can see that little dot just below 2019 levels. We expect this to remain and follow the same path as it did in 2019, and see that it remain elevated into the really for the next 2 months. Now, when we look at gasoline demand, you can see that the only year we're above is 2020. So I should say 2020. I'm sorry, 2021. So we do think that you're going to see this rebound a bit, but it's going to remain depressed. It's going to remain under pressure, especially as we go through, this Omicron, people working from home more. I think that's going to be a weight on that demand as we head into the next 2 weeks. Now, when we look at just where we're getting some of this data from, here's where we just look at Google data. So here you can see workplace dropped and hasn't rebounded. I should say it's rebounded, but to that low, and we don't see it going up. Retail recreation coming down. It's been frigidly cold in a lot of areas. Just frigid, as well as Omicron fears, which is keeping people away from some of this excess capacity. And you can see residential remains elevated, and we don't see that adjusting too much, again, keeping us fairly depressed on the activity side. Then when you look at Apple data, here you can see we had that big drop for New Year's, and we're just going to hold close to the baseline just based on how this is calculated. Now, when you look at propane, another draw of 3.35 million. That brings us to 8.3 million below the 5-year average. But the pace has slowed, and that's really that's something that is impacted based on exports. Exports are still going to remain elevated, but again, it's just going to be some of this overhang just based on where things are heading on the international front. Still strong demand in the U.S. We don't see that changing, and that will be a positive driver. And then, so when you look at where things kicked off this year, we essentially began the year right where we ended it at about 40 days of coverage. So now it's going to be key to see what happens into the end of Jan, and do we get close to that 20-day mark, which is where there's going to be a bit more fear. I think it's likely that's more of a weather question, and if the weather stays fairly cold, we will see some of that accelerated draws, but this chart will be fixed as we go into next week, just based on how the calculation works. So now when we look at jet fuel, you can't really see it because we're right at the tip of where we were in 2018 and 2020. So when you look at demand in general, it's just at the very low end of where we were in those previous years. And instead of going up to where it normally goes to about 1.8 million barrels, I should say about 1.8 million barrels a day, we think it'll drop to about 1.4 and come back to the low end, just based on what we're seeing in the market as that jet stock. We had draws of 500,000 barrels, which is 6.3 million below the 5-year average, and you can see it was all driven by Pad 1. Now, TSA passengers, as we've been saying, it's, especially because 2020 and 2019 are normal years up until obviously the COVID shock that hit at the end of February, beginning of March. We're going to stay fairly depressed during this point. It starts to increase as we go into February break and into March, and as we get into spring break. But, we just think we're going to be fairly, it's going to be fairly weak through January, through February, and then start to increase into the back of February into March. And this is going to keep us and essentially split the uprights between 2021 lows versus where we are today. Now, rounding this out with open table, you can see that on the weekends, we're about 5 to 10% below normal. On the weekdays, we're about 20 to 30% below normal. That's something that we just think is going to remain with Omicron, other issues in terms of people just reducing their exposure. And remember, it's gotten very cold, so the ability to sit outside has been diminished, so you have to go inside. There's restrictions on the amount of people, and maybe others just don't want to take the exposure, and they're just going to hit pause and look to go out to dinner in February and March as things cool off. But that's what we have in the U.S. so far. And now in the next segment, we're going to go broad and look at that global market in general.